Hey everyone, and in this video we're going to be working on the homework questions for chapter 6. So without further ado, let's jump in. Okay, so for question number 1, we have an adjusted trial balance, and our task here is to prepare the financial statements, basically the income statement, statement of owner's equity, and the balance sheet. So to start, I'm going to do a little screenshot here so I can see the trial balance and this information a little bit easier. One thing to note too as we go, it's not just the trial balance, but we have to keep in mind that they're telling us that this amount in capital includes a $6,990 investment that was made into the business during the month of May, basically. So that will figure in the statement of owner's equity. Okay, so when we get down here for the income statement, we're just basically pulling off numbers from the adjusted trial balance. So that's 5830 for revenue, advertising expense 360. So again, just pulling these in one by one off the, which one was that? Interest 210 and 1300. So again, you can kind of see the bottom of that interest expense, rent expense. Like I said, I've got a screenshot on the other page for that, but that's where those numbers are coming, just directly off the adjusted trial balance. Okay, and then I'm going to sum up all the expenses. So 360 plus 370 plus 400 plus 210 plus 1300 gets us to 2640. And then 5830 minus the 2640 gives us $3,190 in net income. And okay, so that's the completion of the income statement. And now I'm going to hit the check button though, just make sure I didn't do any math wrong or anything, because it'll kind of haunt us as we carry through. So important note, and we'll talk about this in class too, but there's a flow and a progression. We want to complete the income statement first, then the statement of owner's equity, finally the balance sheet. So the reason why we want to do that as well too, we want to calculate net income, which is going to come to the statement of owner's equity. So let's go ahead and put that in. So we've got net income now, we bring that down. Now we want to put in beginning capital, and this is where the $6,990 investment comes into play. And you can see that the total in the capital account now is $47,560. But like I mentioned, that includes the $6,990 of investment. So we need to back that amount out. So if we take the ending balance of $47,560 minus $6,990, it gets us $40,570. Excuse me, and then we need to put the investments that were made shown separately down here. So then we're just going to add our net income and our investments to get a total for the total additions. So 10,180. That's the sum of those two, and then we just need to add these two together here. So 10,180 plus 40,570 gives us 50,750. And then we have our withdrawals of 1,560 we want to combine in here. So that's the final piece that we're going to subtract out. And that leaves us with an ending balance in capital of 49,190. Okay, so that's the second statement complete. Let me just do my check figure again, make sure nothing's going wrong as we're going through. Looks good. Okay, so now that, and again, the progression here, so net income was brought down to the statement of owner's equity. So that's why we did that first, this second. And now capital we're going to bring down to the balance sheet. So we know what the ending balance of capital is here. And we're going to put that 49,190 down here. So that goes here. And the balance sheet then we just go through basically and populate the balance sheet with all the balance sheet accounts. And I'm just pulling these directly off of the adjusted balance sheet above, and net equipment. Do a little bit of math here, so let's get our net book value. 62,910. Also, I want to see if, I think we might not need the negative sign there. I'm going to assume we don't. Let's try that first. Okay, then we'll add all the assets together and we get 80,250. I'm going to do a check just to, yep, okay. So usually, and that's something to kind of note, if it says less, then you typically don't need a negative sign, is kind of how that works. Even though it looks positive, this number is this minus this, and we don't have a positive sign here for that number, but it says less, which is another way of saying subtract this from this, essentially. So just something to keep an eye on. Okay, accounts payable, we've got 9,990, interest payable 140, unearned revenue 5470, notes payable 15,460. Let's add all those liability accounts up here. So 9990, 140, 5470, and 15,460. And I get 31,060. And then if we add the 31,060 and the 49, add these two together, total liabilities and owner's capital, we get 80,250. And that's kind of our, our accounting equation essentially is now balanced, right? Assets equal liabilities plus equity. So good to go. Full points on that one. And let's move to the next problem. Okay, let's take a quick look at this problem here. So this problem asks us to take our adjusted trial balance here and prepare some closing entries. So again, I'll take a quick screenshot so I can more easily see those without scrolling too much. And let's follow our process for the close accounts. And it kind of guides us here. So we want to close our revenue accounts, right? And so when we're doing our closings, keep in mind that what we want to do is to essentially, if an account has a credit balance, we want to zero that account out. We want to debit that account then to get it to go to zero. So service revenue has a credit balance of 5,330. Oh, excuse me. So we want to debit that account to get it to go to zero, and we're going to move that. I believe income summary. So we're moving this into the income summary, and then we're going to close our expense accounts. So here's we're going to credit all these expense accounts because for the close, a normal balance for a expense account is a debit. So we are going to credit those accounts to get them to essentially, to get them to go to zero and basically transfer their balances into this income summary is essentially what we're doing. So let's see, 390, 380, 320. Okay, and then we're going to want to add all those together so we know how much is going to go into the income summary. So I have 1830. Okay, now we want to close the income summary into capital. And so essentially one way I find kind of handy to do this is you want to balance these income summary debits and credits. This is kind of how I usually do this mechanically, or just help me remember. So if we have 5,330 on this side and we have 1830 here, we need another debit to get this to balance out to the 5,330. And that's 3,500 then. So in other words, if you look up at these accounts above and we've got the credit for income summary and the debit, Now we need another debit to make sure that those all balance out. And now 1830 plus 3500 would equal 5330, so that balances. And then the other side of that transaction will be capital. So we're moving these amounts, essentially the whole process moves them into capital. And then finally we have withdrawals being moved into capital. So we have a debit balance for withdrawals initially, so we want to credit that to get it to go to 0, and 680 is the balance there. So let's hit our check button, make sure we got everything in right. Looks good. Okay. And now we're going to want to go through and just put our adjusted trial balance together. So one easy place to start here is just to go through and, input all the accounts that don't get closed. And, they provide you with the post-close trial balance here with the accounts already listed. So pretty easy to just pull all these in off of the trial balance above. Not really a whole lot you're doing there other than just inputting, transposing from that trial balance to here. So let me finish that. Notes payable. Sorry, I'm getting lost there. Okay, and then the one account that does change, the main thing here is capital, right? So that's what we're doing with our journal entries above. You can see capital has been adjusted here, and it's been adjusted here to close all the withdrawals and the revenues and expenses into capital. So one thing, though, so we're going to start with a balance of 12,200, and then we're going to increase that by 3,500. And remember, capital has a credit balance, so you can see we're crediting capital here, and it's going to increase. And then we're going to decrease capital here by 680, which ends up getting us a total of 15,020, which again is the beginning balance of 12,200, and then plus 3,500, so getting credited to increase it, and then minus 680 with the debit to reduce capital. Okay, let's go through and do our addition here. I get 21330 on the credit side. And then on the debit side, we got 21330. So looks like we put everything in right. Let's just hit our check button, make sure we're good. And yep, full points there. So that does it. And yeah, the one little, the trick I hope kind of take away from this, if you're struggling with the closing entries, is I think just one little thing I think that helps me when I'm going through doing this. It's always kind of the same process, close revenue, close expenses, close the income summary to capital, and then close the draws. And so, like I said, one little trick of knowing how much to close from the income summary to capital is just to look at the two income summary debits and credits above and see whether you need to book a debit or a credit to make those balance. And then the other side, whatever it ends up being, will be capital. So just a little a little hint, I suppose. Just a little, method there. Okay, so this problem is exactly the same as the last one, more or less. So I'm going to leave this to you all to complete. So any questions, reach out to me specifically on this problem. But I think if you look back at the video for the prior problem, it'll walk you through the process needed, and you can practice some of what I went over there. And same thing for this problem here. So more practice is always good. So look back if you need help on that. Okay, question number 5. We're going to look at classifying current assets versus non-current assets and total assets, so on and so forth. So this is a pretty easy problem, I suppose. I'm going to copy these into my Excel I've got open. Okay, and what we want to do here is to just kind of, I'm going to, looking at these. So accounts payable is a short-term liability. Short-term investment is I'll call them a current. That's kind of the current versus non-current is the proper terminology, technically speaking. So land is a non-current asset. Cash is a current asset. Factory equipment is a non-current asset. Notes payable is a non-current liability, unless you see notes payable short-term portion. So it can be broken out. Sometimes a portion of the notes payable can be current if it's the portion that would be paid within the next year, essentially. But for our purposes here, mostly in this class, we just assume all the notes payable are non-current. Office furniture is non-current. Prepaid expenses is current. And unearned revenue is a current liability. So then we're going to custom sort, or I've got it on my Excel here. I'm working off screen just real quick to be able to do this for you guys. Okay, so what I'm doing is just sorting these into what they are, so it's a little easier to see. So our current assets include the short-term investments, the prepaid expenses, and the cash, 18,660. So if we sum all three of those up, 15,590 plus 27,630 plus 18,660, I get 61,880. Hit our check button. Woohoo! All right, that is right there. Okay, and then non-current assets, we have office furniture, land, and equipment. And so that's let's see here. So office furniture, land, and equipment. And if we add all three of those totals up, 13,110, 34,870, 31,340, it comes out to 79,320. And then just adding those together, essentially, it's current assets plus non-current assets equals total assets, more or less. Then we get 141,200 and 100%. Okay. Perfect. So, not a super involved problem, but it is a good practice to be able to identify between current and non-current with all that stuff. Okay, so speaking of the non-current liabilities and the current portion, etc., let's look at this problem here. So, question 6 says, suppose a business has $426,000 of a bank loan taken out December 31st, 2024. We have to the borrowing arrangement requires us to pay $106,500 by September 2025. So we need to see how we're going to report this. So the current portion of a long-term bank loan is the portion that would be repaid within the next 12 months of the principal that would be paid. And so September 2025 is within 12 months of the end of the year here at December 31st. So that's going to be our current portion, the 106,500. And then the total amount that's, outstanding is the 426,000. So all we need to do to figure out what the non-current portion is just take the current portion away from that. So that's 319,500. Check, 100%. Pretty straightforward. So hopefully that's helpful there. Okay. Okay, similar problem here, but a little more, involved in terms of calculations and current, non-current, and all that. So the total amount is $958,000. They're saying interest-free, so everything, all these payments are just principal. Payment is in 4 equal installments. And I think what we're saying is they are due on January 1st of the next year. So if we're at December 31st, 2024, then I guess the first thing to do, because it's telling us it's going to be repaid in 4 equal installments. So if we divide the outstanding balance in total by 4, we get 239,500. So 958,000 divided by 4 gets 239,500. And then that portion will continue to be the current portion the whole time, basically. And I think the last payment that will be made, I'm thinking here, is January 1st, 2027, or sorry, 2028. So December 3rd, the day after December 31st, 2027. So at that point, we have no non-current portion. It's just that one last payment to be made. Oops, I put that in wrong. And then really we just need to, I think, separate these out. So the first time we're going to equal the total because no payments have been made yet. So 718,500. So if you added these two together, you would get the total amount. But now at 2025, we will have made this one payment so far. So then we're going to want to account for that fact. So then we go 479,000. So we're decreasing this down. And then at the last year before payment here, this is we just have two payments left basically. So then that current portion gets paid on January 1st, 2027. So that goes away. And then at the end of the next year, it just comes down to that one last balance. Okay, maybe we didn't even need to put a zero in there, but 100%. So hopefully that makes sense. The principal is decreasing with each payment, but the payments are the same over the forward, and the current portion is the amount of the next payment as long as it's within 1 year. And yeah. Okay, so this problem talks about current liabilities and non-current liabilities. So this one, again, I'm going to do a little bit of copy paste into my Excel here, make it a little easier. So accounts payable is a current liability. Interest payable is a current liability. Salaries payable is a current liability. So the only non-current liability that's on this list is the portion of the notes payable that is not current, basically, but will be paid after the next 12 months. So in the next 12 months, we have one payment to be made of this. So that is a current liability, and then this is the residual portion there. So basically, we just need to add everything up other than that non-current 24,880. So that leaves us with 43,210. And then non-current is you're not really going to calculate. It's just that's the only one there that is non-current, essentially. So pretty easy and straightforward. Okay. Question number 9. For the following independent transactions, determine the amount of current and non-current liabilities. Okay. We borrowed $239,000 from the bank. The full amount is due on September 30th, 2025. So I think that is, that is the exact 1 year mark. So the whole amount should be listed as current, I believe, then is what they're getting at, because it's all going to be repaid within 1 year. There is no non-current portion. This company purchased a small building at $210,000. Down payment is $90,000. Remaining balance payable in 5 years. Annual payment $24,000. So we have $210,000 minus the down payment of $90,000 brings us to $120,000. And that $120,000 is going to be repaid, it says, in 5 years. So 5 $24,000 payments. And if you do that math, those 5 add up to the $120,000 outstanding after the down payment, and that's the whole thing being paid off. And it's going to be starting next year. So basically, we want to say the next payment is going to be the $24,000, and then the residual portion that we owe on that $120,000 is just the non-current piece of $96,000. Add those together, you get the $120,000, which is the $210,000 minus the down payment. Okay, during January 2020, business owner, we got interest-free loan is $119,000 for annual installments of $29,750. So really easy. I mean, these problems are pretty simple because it tells us more or less what is the next the payment that will be made within 12 months, and then we just need to separate that into those two pieces. So this is the payment amount, and then this is the rest of the 119,000. Add those together, it would get you to the 119,000 basically. And okay, so here borrowed 11,000. The payment will be made after 3 years. So this one is all non-current because there's no portion of this liability that's going to be required to be repaid within the next 12 months. So that's how you get all non-current on this one. Now, in 2 years passes, and at the point at which this 11,000 is due within the next 12 months, at that point in the future, then it would be all current, basically. So that's the kind of the thought process there. Okay, so now we've got a problem of calculating out the classified balance sheet and the ratios. This one, I think I'm going to leave for you all to do. It's just a process of, taking all of these amounts here and then plugging them in, or, doing the drop down. So it's not like really complicated work necessarily. And then look in your notes or the book for the calculation of these ratios and metrics. And those are really pretty basic metrics. So I don't think you guys need me to hold your hand through that necessarily, but definitely reach out if you have any specific questions on that as you're working through. Okay, let's take a look at this one. Looks okay. This is the same thing. In this one, we need to do a little bit of work to identify what is the current and non-current portion of the notes payable. So that will need to be separated out. So that's the only real kind of work you have to do, or analysis. And then the rest of it, again, is just plugging these amounts in down below. So I'll leave that up to you as well. And again, reach out to me if you have any questions, but hopefully that's a pretty basic, straightforward problem that's not too challenging for you all. But again, if it is for any reason, reach out and I'll be happy to help one-on-one. All right. Thanks, everybody. Have a good day, and I'll talk to you soon.